Imagine an ETF that is built for one purpose: to stay aligned with strength and leave underperformance behind. Instead of holding stocks simply because they belong to an index, this ETF is designed to continuously focus on companies that are actually delivering results. It systematically removes lagging stocks and reallocates toward those showing strong, sustained performance, allowing the portfolio to adapt as market conditions change. In this video, I'm going to discuss an exceptional ETF that consistently outperforms the S&P 500. Next, I will explain why daily and weekly investments are often better than one-time lump sum investments. And at the end, I will show you and Bobby how a $10 daily investment in this unique ETF can yield a whopping $4 million portfolio. Listen, right now, fortunes are being built, not by luck, but by those who positioned themselves before the world noticed. We're talking about $10 a day, the same amount that vanishes into forgotten coffee, cookies, and subscriptions. The window is open. The question isn't whether you can afford it. It's whether you can afford not to. Welcome to Investments Mindset, where wealth builders come to get inspired. Before we continue, please note that we are not financial advisors. The content on this channel is for educational and informational purposes only. It is not intended to provide investment advice or recommendations regarding specific securities or investments. Always conduct your own research or consult a qualified financial professional before making any investment decision. Every investment involves risk. Let's dive in. Firstly, investing in the S&P 500 is a solid move, no question. But here's the thing. We're not talking about if you'll reach your destination. We're talking about how fast you get there. Think of it this way. The S&P 500 is a reliable sedan. It'll get you where you're going, steadily, predictably. But what if you could take a sports car on the same route? Think about this for a second. Despite all the macroeconomic issues in 2025, it returned over 26.58%. To put that in perspective, SPMO's return in 2025 was over 50% better than the S&P 500. Here is what makes SPMO different from every other fund you own. While most ETFs force you to ride out the bad times, SPMO plays a completely different game because every 6 months it kicks out the losers and doubles down on the winners. Think of it like a sports team that cuts underperformers mid-season and recruits the hottest players. The fund only holds S&P 500 stocks with the strongest upward momentum, meaning the ones actually making money right now. You might think this sounds risky, but SPMO stays surprisingly diversified. Technology makes up about 34% of the fund, while the rest is spread across financials, communications, industrials, and a wide range of other sectors. This spread across different areas of the market means you are not gambling everything on one corner. You get the thrill of momentum investing with built-in protection. SPMO is designed to surf the wave of whatever is working in the market at any given moment. It is not buy and forget. It is buy and optimize, constantly tilting towards strength and away from weakness. For investors tired of watching their funds drag along underperformers, SPMO offers something genuinely different: a portfolio that only wants winners on the team. The stocks with the strongest 12-month track records are rewarded with larger positions in the fund, while the weakest performers are either reduced or removed entirely. The beauty of this approach is that SPMO typically holds around 100 large-cap stocks, so you are still getting solid diversification across major companies. However, the key difference is that the winners receive much heavier weightings than they would in a traditional index fund. Since its launch, SPMO has frequently outperformed the S&P 500 during periods when the market shows clear trends and strong momentum. What makes this truly exceptional is the risk profile, because SPMO was engineered to capture higher highs when the market rallies while also delivering higher lows during downturns. In other words, when conditions deteriorate, SPMO often does not decline as sharply as the traditional S&P 500 because it has already shifted away from struggling stocks, giving investors greater upside potential with a built-in cushion on the downside. These factors created widespread uncertainty that pushed prices lower, turning earlier gains into a full-year loss for the S&P 500. However, momentum-based ETFs like SPMO held up better because they focus exclusively on the highest momentum stocks, which are typically companies already outperforming their peers and often more resilient during volatile market conditions. By emphasizing stocks that have recently demonstrated strength and rebalancing on a semi-annual basis, SPMO can tilt toward assets that continue trending upward or decline less sharply, helping to reduce drawdowns compared to the broader index. For instance, if you consider the impact of the events that impacted the market in 2022, when the market was dominated by surging inflation and rapid interest rate hikes that pressured equity valuations and dragged the S&P 500 into a steep decline, marking its worst year since 2008. As aggressive central bank tightening, lingering pandemic-related supply disruptions, reduced liquidity, and rising recession fears weighed heavily on investor sentiment. In this case again, SPMO loss was less than SPY because momentum stocks often already priced in strong earnings growth prospects and tend to be in sectors that weathered macroeconomic stress better. Momentum selection also enabled SPMO to trim lagging stocks sooner, mitigating some losses as the market rotated. Listen, the bottom line is that while both ETFs were negative during those downturns, SPMO's focus on leading stocks with strong recent performance and its dynamic rebalancing helped it limit losses relative to the broad market cap weighting of SPY, illustrating how a momentum factor can be more resilient in certain correction environments. As the saying goes, numbers don't lie. So let's dive into the 10, 20, and 30-year projections of SPMO. These projections are based on SPMO's conservative 5-year annualized return of approximately 19%, which represents the fund's actual historical performance over its most recent half-decade of operation. The calculations assume Bobby invests $10 per day, totaling $3,650 per year, with SPMO's current dividend yield of around 0.65%. And all dividends fully reinvested back into the fund to maximize compound growth. The formula used to calculate these projections is future value equals P multiplied by the quantity of 1 plus R raised to the power of N minus 1 divided by R, and then multiplied by 1 plus R, where P represents your annual contribution of $3,650. R stands for the 19% annual return, expressed as 0.19. N represents the number of years you're investing, and the final multiplication by 1 plus R adjusts the calculation to account for contributions made at the beginning of each period rather than the end. In simpler terms, this formula calculates how much money you'll have in the future when you make regular contributions that grow at a consistent rate over time, with the adjustment ensuring accuracy since you're investing throughout the year rather than in one lump sum at year's end. Now, let's dive into the 10-year projection. To calculate the 10-year projection, we start by taking 1 plus R raised to the power of N, which gives us 1.19 raised to the 10th power, equaling 5.6947. This number represents how much a single dollar would grow to after 10 years at a 19% annual return. Next, we subtract 1 from this result, giving us 5.6947 minus 1, which equals 4.6947. This step isolates just the growth portion, removing the original dollar. Then, we divide this growth factor by R, so 4.6947 divided by 0.19 equals 24.7089. This division adjusts for the fact that Bobby is making multiple contributions over time rather than one lump sum investment, with each contribution having varying amounts of time to grow. We then multiply this result by P, so $3,650 multiplied by 24.7089 gives us $90,187. Finally, we apply the beginning of period adjustment by multiplying $90,187 by 1.19, which gives us our final projected portfolio value of $107,323. After 10 years of investing $10 daily, Bobby's total contributions would amount to $36,500 of his own money. his projected portfolio value would reach $107,323, meaning his total gains would be $70,823. This represents a return on investment of 194%, which means Bobby's money has nearly tripled. Every single dollar he invested grew to roughly $2.94, demonstrating that SPMO's momentum strategy did nearly twice the work that he did simply by showing up consistently with his daily $10 contribution. Next is the 20-year projection. Before we continue, if you find value in this video, even just a little, please subscribe and hit the like button to help us continue to provide more insightful and educational videos. Your support is highly appreciated. Thank you. To calculate the 20-year projection using the same formula, we begin by taking 1 plus r raised to the power of n, which gives us 1.19 raised to the 20th power, equaling 32.4294. This dramatically larger number compared to the 10-year calculation shows the accelerating power of compound growth over longer time frames, demonstrating how much a single dollar would multiply after 2 decades at a 19% annual return. Next, we subtract 1 from this result, giving us 32.4294 minus 1, which equals 31.4294. This step isolates the pure growth component by removing the original principal amount. Then we divide this growth factor by r, so 31.4294 divided by 0.19 equals 165.4179. We then multiply this adjusted factor by p, so $3,650 multiplied by 165.4179 gives us $603,775. Finally, we apply the beginning of period adjustment by multiplying $603,775 by 1.19, which produces our final projected portfolio value of $718,493. After 20 years of disciplined $10 daily investment habit, Bobby's total contributions would amount to $73,000 of money that actually came from his pocket. But check this out. His projected portfolio value would reach $718,493, meaning his total gains would be $645,493. This represents a return on investment of 884%, which translates to his money growing nearly 9-fold. Now my favorite, the 30-year projection. We'll calculate the 30-year projection using the identical formula. We begin by taking 1 plus r raised to the power of n, which gives us 1.19 raised to the 30th power, equaling 184.6753. This explosively larger multiplier, compared to both the 10-year and 20-year calculations, reveals the truly staggering power of exponential compound growth over 3 decades, showing how a single dollar would mushroom after 30 years at a 19% annual return. Next, we subtract 1 from this result, giving us 184.6753 minus 1, which equals 183.6753. This step strips away the original principal to isolate only the growth component that compound interest has generated. Then, we divide this massive growth factor by r, so 183.675. 3 divided by 0.19 equals 966.7121. We then multiply this adjusted factor by p, so $3,650 multiplied by 966.7121 gives us $3,528,499. Finally, we apply the beginning of period adjustment by multiplying $3,528,499 by 1.19, which produces our final projected portfolio value of $4,198,914. After 30 years of maintaining unwavering $10 daily investment discipline, Bobby's total contributions would amount to $109,500 of actual money that flowed from Bobby's earnings into the market. Now, check this out. His projected portfolio value would reach $4,198,914, meaning his total gains would be $4,089,414. This represents a return on investment of 3,734%, which means Bobby's money grew more than 38 times over. 3 decades of unwavering $10 daily deposits, combined with SPMO's 19% annual momentum-driven returns, creates genuinely life-changing wealth. Bobby contributed just under $110,000 over those 30 years, but the compound growth multiplies that by over 38 times into more than $4.1 million. His gains of over $4 million represent roughly 37 times his initial contributions, demonstrating that the exponential compounding effect did virtually all the heavy lifting, while he simply maintained the consistency of showing up every single day with his $10 investment. Listen, friends, your $10 daily habit could be the key to your financial freedom. If you're serious about building real wealth, then consider this channel your financial gym. Every video is a workout for your portfolio, your mindset, and your money skills. If today's video helped you level up your financial education, even just a little, please smash that like button and subscribe so we can continue to grow and build wealth the smart way. Please note that we are not financial advisors. The content on this channel is for educational and informational purposes only. It is not intended to provide investment advice or recommendations regarding specific securities or investments. Always conduct your own research or consult a qualified financial professional before making any investment decision. Every investment involves risk. Click on the next video on your screen. Thank you, my friend.